This video is lesson 4 on credit. Some advantages and disadvantages of credit. Some advantages are that you're able to buy needed items now, so you don't have to wait for them. You don't have to carry cash with you, is an advantage. It creates a record of your purchases, especially if you do online purchases with credit cards, even with it will keep a record of those. It's more convenient than writing checks. It consolidates bills into one payment. Some disadvantages are that it may be your interest is higher, so a higher cost of the item as well if you don't shop around, and especially if you don't pay off the bill at the end of each month. It may require additional fees depending on the credit card that you use. Financial difficulties may arise if one loses track of how much has been spent each month. And there's an increased impulse to do impulse buying. There's an increased impulse buying that happens. There are 3 C's in credit. Character. Will you repay the debt? That's the first thing that they're going to ask you before they give you credit. They're going to look at your credit history and look to see if it looks like you possess the honesty and the reliability to pay your credit debts. In other words, have you used credit before? Do you pay your bills on time? And they'll even look at your utility bills. Do you have a good credit report? Can you provide character references? How long have you lived where you're living now at your present address? And how long have you been at your present job? So they're also looking for stability. Have you stayed somewhere for a while? The next C is capital. What if you don't repay the debt? Do you have any valuable assets, such as real estate, savings, or investments, that could be used to repay credit debts if income is unavailable? What property do you own that you can secure the loan? Do you have a savings account? Do you have investments to use as collateral? So they're looking for capital, which also could be called collateral. Capacity, can you repay the debt? Have you been working regularly in an occupation that is likely to provide enough income to support your credit use? Many companies will not give you credit unless you have worked a year in the job that you're at. It just depends on what kind of job you're working at. If you have a job where you have a contract, they may do so before the year is up. Do you have a steady job? What is your salary? How many other loan payments do you have? What are your current living expenses? What are your current debts? And how many dependents do you have? So they want to know capacity, whether you'll be able to pay the debt back. Your responsibilities are to borrow only what you can repay, to read the credit contract thoroughly, make sure that you understand that credit contract, to pay the debts promptly, to notify the creditor if you cannot meet the payments. The instant you cannot meet the payments, the creditor should be notified and some sort of payment plan should be instated. Report lost or stolen credit cards promptly. And these days, it's also to report if it looks like someone has used your credit card. So you want to check that online. Never give your card number over the phone unless you initiated the call or are certain of the caller's identity. So you want to be very careful about giving your card number over the phone. You have certain rights, and we'll look at these in this course several times. The Truth in Lending Act was actually occurred in 1968. This ensures that consumers are fully informed about cost and conditions of borrowing. The Fair Credit Reporting Act occurred in 1970. This protects the privacy and accuracy of information in a credit check. The Equal Opportunity Act was in 1974, and this prohibits discrimination in giving credit on the basis of sex, race, color, religion, national origin, marital status, age, or receipt of public assistance. And you'll probably see these again in the course. Fair Credit Billing Act in 1974 sets up a procedure for the quick correction of mistakes that appear on consumer credit accounts. And in 1977, the Fair Debt Collection Practices Act prevents abuse by professional debt collectors and applies to anyone employed to collect debts and to others. Does not apply to banks or other businesses collecting their own accounts. To build a credit history, you need to first establish a steady work record, one that you stay there for a while. You don't want to jump from job to job because that is not building your credit history. You want to pay all your bills promptly. You want to open a checking account and don't bounce checks because that will also show. You want to open a savings account and make regular deposits. Apply for a local store credit card and make regular monthly payments. Apply for a small loan using your savings account as collateral. Get a cosigner on a loan and pay back the loan as agreed. So for all of those last three, you want to be very careful. It's important that you do build your credit, but you want to be sure that you don't overextend yourself and that you're able to make those loan payments, start out small and make them every month. Because you could end up doing the exact opposite of what you were trying to do and create problems with your credit. Some types and sources of credit. The first one is a single payment credit. Items and services are paid for in a single payment within a given time period after the purchase. Interest is usually not charged, like utility companies is an example of that, and medical services. The next one is installment credit. Merchandise and services are paid for in 2 or more regularly scheduled payments of a set amount. Interest is included. Some retail businesses, such as car and appliance dealers. Money may also be loaned for a special purpose with the consumer agreeing to repay the debt in 2 or more regularly scheduled payments with commercial banks, consumer finance companies, savings and loans, and credit unions. In an installment credit, many times you see this with furniture stores. If you can have no interest if it's paid in 24 months. After that, the interest will have accrued for those whole 24 months, so you want to be sure that you get those installments paid before those 24 months are up. It's a good way to buy if you're sure you can make those payments. And the last one is revolving credit. Many items can be bought using this plan as long as the total amount does not go over the credit user's assigned dollar limit. Repayment is made at regular time intervals for any amount at or above the minimum required amount. Interest is charged on the remaining balance. Retail stores are one, and some financial institutions that issue credit cards such as Discover, MasterCard, or Visa. You want to be very careful with revolving credit because you could accumulate quite a debt if you go to the maximum amount for the credit card and have to pay the minimum only each month. It will take you forever to pay those off and you will have accumulated a lot of interest. So you want to be smart with your money and not get into those kinds of situations. And finally, the 2010 rule, how much can you actually afford? And we'll look at this several times in this class, so you want to be sure you understand this formula. You should never borrow more than 20% of your yearly net income. So if you earn $400 a month after taxes, notice it said net income, then you would multiply 12 months times 400, so that's 4,800. You'd calculate 20% of that, which is 960 for a safe debt load. So you should never have more than $960 of outstanding debt. And note that housing debt is not a part of that. Monthly payments shouldn't exceed 10% of your monthly net income. If your take-home pay is $400 a month, then multiply 400 times 10%, and so $40. Your monthly payments should not be more than $40 to pay off your debt. And again, housing payments are not included as part of that. End of the video on lesson 4.